It has been an exceptionally brutal year in the stock market so far, and many people are blaming these major losses because of President Trump's tariffs, setting us up for what could be the worst quarter for U.S. stocks since the start of the COVID pandemic in 2020. But the bigger the crash, the bigger the opportunity for you to get rich, especially if we can be greedy when others are fearful. Today, I'm going to walk you through everything you need to know about the market crashing, how far stocks could drop, and which stocks could win big as a result. This may end up being a once-in-a-lifetime opportunity, so strap in and let me show you why I'm excited by all this red. This strategy comes from economist Stephen Moran's blueprint, Tariffs as Leverage to Renegotiate Deals. The idea is they need us more than we need them. So if we impose these tariffs on things that they really badly need to sell us, they're going to back down and make things a little bit easier for us. Impose these reciprocal tariffs to level things out. Weaken the dollar to boost exports without killing our reserve currency status. Sounds tactical, but there is a catch. Some countries with trade surpluses, like the United Kingdom, got hit too. That's not exactly fair play in a lot of people's eyes. And now we're seeing retaliation, especially from China. So what does this mean for you as an investor? Falling exports lead to lower corporate earnings, which lead to dropping stock prices. But if you're a value investor, this is your moment. Market panic creates mispriced stocks. And even if corporate earnings do fall, that could very well be temporary, driving down stock prices to buy stocks at cheaper prices. Now, while everyone else is running away, we're doing what Warren Buffett taught us. We are buying wonderful companies at wonderful prices. These aren't just cute little phrases for us to say while we do stupid things like buy hype and speculation. Guys, it's been a while since we've been in a real long bear market. Yeah, we had 2022. Yeah, we had COVID, which lasted about a month. But before then, it's been all the way back to the great financial crisis. And here's a fact that most investors do ignore. Bear markets do not last forever. But we're in the middle of them. You feel like, oh, gross, and how can this get better? That's the recency bias. And the good news for a person who can take themselves out of that situation, take themselves out of the stomach pain and go, okay, eventually this will pass. And when it does pass, it'll be glorious. On average, bear markets run about 11 months and stocks drop about 32%. Is it painful? Of course it is. But here's the kicker. Bull markets last over 4 years and bring gains of around 150%. So, are you willing to endure 11 months and 32% drop to get 4 years and 150% on average? Of course you are. Downturns are short, recoveries are long, and if you're paying attention, the crash gives you time to prepare and pounce. The best quote I know of, and I repeat it in so many videos, is Morgan Housel saying every past crash or bear market looks an opportunity and every future one looks like a risk. They're all opportunities. So, how do you know when to strike? Well, the fear and greed index. Right now, it's flashing extreme fear. But let me give a little caveat to that. I kind of laugh at that short-term fear and greed index. The one that I see on CNN is too short-term. It's not about the long fear and greed. You know, you go back to the Peter Lynch statement. He says, hey, listen, I have a cocktail party theory. If I go to a cocktail party and everyone's telling me what stocks to buy, I know stocks are overpriced. If everybody feels bad for me for what I do for a living because I buy stocks, then I know it's probably a time to buy. So I look at that saying, extreme fear to me is when you're at the cocktail party and people feel bad for you. Every indication to me right now is we're not at that point. Are we in a temporary extreme fear because we had such a big drop so quickly? Absolutely. But the real long-term extreme fear, when you get to the point that I experienced in June 2003, when I was at a work conference and somebody said, well, you can't make more than 3 or 4% in the stock market. Back then, I didn't realize what that meant. But now looking back on it, I'm like, oh yeah, that's what that means. That's music to a value investor's ears. The most overused Warren Buffett phrase, be fearful when others are greedy and greedy when others are fearful. Could this be that moment? I don't know. Just because things are cheaper doesn't make them cheap. That's a very important thing that everybody has to understand. Cheaper does not mean cheap. And then we have the volatility index, the VIX, Wall Street's fear gauge. When it spikes, panic is everywhere, and it has spiked incredibly as of late. So what's the bottom line? Don't run from downturns. They're not danger. They're discounts. And if you've done the work, and if you know your companies, this is when you can build immense wealth. Are there companies out there right now that are selling for what I consider to be very, very low prices? Absolutely. I own 26 or 28 companies, and a few of them get even better in pricing. But I don't think the market in general, as a whole, is screaming that fear pricing. I think it's just screaming a temporary fear pricing. So stop fearing the storm. I think it's going to get worse if this bear market continues. Start learning how to surf the cycle. Remember, death, taxes, and cycles. Those are 3 guarantees in life. Guys, you're never going to be able to pick a bottom. So when you see an opportunity in the market, but you feel like you're still in the early stages of a bear market, do what I do. Dip in. Sell cash secured puts that allow you to buy stocks at lower prices and be paid along the way. The other thing to do is, in our software, we have our stocks at the 52-week low. These are all the stocks that are selling within a few percentage points of the 52-week low. Look at all these companies: Dell, Marathon, Prudential, a lot of big names in here. This is a great place to start because when stocks are hitting 52-week lows, it's a great place to look at and say, okay, has there been a shift in that short-term voting machine that is the stock market? Have people gone from we love the stock to we don't like the stock? So let's go pick 3 stocks here to do 52 on the 52-week low. Let's first pick Google. So I'm going to go to Google here. I'm going to do a stock analyzer. Now, guys, the stock analyzer tool, here's my thesis for how I handle the stock analyzer tool. When I first see a company, I look at quickly the 8 pillars, higher level metrics, and then I go to stock analyzer tool. And the reason being is I don't want to waste my time diving deep into 10Ks understanding it. Guys, time's too valuable. If the stock's nowhere close to my price, why waste any time on it? The stock analyzer tool allows me to take this story and the numbers and put them together. And I'm going to be a little more conservative on the stock analyzer tool. So the last time I did this for Google, I did 4, 8, and 12% revenue growth over the next 10 years. I did 22, 24, and 26% profit margin and free cash flow margin. And then I did a PE of 20, 23, and 26. Now, guys, for all of these are estimates. I like having a range because the range allows me to give a widespread area of, okay, if they do poorly, they'll probably do 4% revenue growth. If they do very well, maybe 12% if some of their bets work out. But all of these are estimates. Now, the great thing about this is this tool is used 1 million times or more every single year by our users because it allows them to put their own estimates in here. Now, finally, I put a desired return in here for 9%. This is basically, hey, Paul, what's the intrinsic value? What's this company worth to the market based on these assumptions? But remember, you need margin of safety. How do you get margin of safety? You increase your desired return because the higher your return, the lower the price. In order to get a high return, you have to pay less money. So whatever your desired return is, put it in here. If you know Google very well, it's probably going to be lower than somebody who's just like, you know what? Either I have Google or I don't know it very well. I hit the analyze button and it's going to spit out a bunch of values for me. Okay. I have a low price of 122, high price of 330, middle price of 200. At the middle assumptions, based on the current price of 153, I'm looking at a 12.5% return over the next 10 years based on a discounted cash flow. So to me, this tells me, Paul, hey, maybe I should go take a deeper look because it's actually selling for a pretty reasonable price. If this was like 7%, I'd be like, yeah, I'll wait a little bit. Maybe add it to my stock at my watch list and wait for it to hit the price. So this is how I use the stock analyzer tool to save time and have a good idea of what the future cash flow for the business means for my returns. Okay, guys, let's look at 2 more. Nike, company I currently own, but remember, don't ever buy a company because anybody on the internet, hell, even for Warren Buffett, don't buy because he has it. But I look at Nike and this thing has been beaten down. $180 is the all-time high. It's now at $57 a share. Here are my assumptions for the future. Next 10 years, 3, 5, and 7%. Profit margin of 10, 11, and 12. PE, 20, 23, and 26 for both Google and Nike. And our next company, I believe they deserve higher than market PEs because they're moats. They have high returns on capital that are growing. So I believe they deserve it. And my 9% return, hit the analyze button. Guys, look at this. Green all the way around. A low price of 58, high price of 115, middle price of 83 with a potential 14% discounted cash flow return. Last company I want to do. Let's pull up Microsoft. I think Microsoft is a great company that has been beaten up lately. So here are my assumptions on Microsoft. 6, 9, and 12% revenue growth for the next 10 years. 32, 34, and 36% profit margin. Free cash flow was slightly lower. So I went with 28, 31, and 34. PE of 20, 23, and 26, and a 9% return. I hit the analyze button. Boom. I have a low price of 225 to 260, high price of 530 to 560, middle price of 350 to 380. If you look at this one, guys, we have an 8% return potential based on discounted cash flow. So for me, I just have in my watch list at a much lower price to sit there and say, you know what? Let me wait until it hits that. By the way, my lower price is going to be different than yours. And the reason being is I have businesses upstairs that generate me cash flow. I can be pickier than the average person when buying my stocks. Now, guys, we talked about our 8 pillars here. This 8-pillar quick analysis allows me to go in and say, okay, what's the story here? Now, this 8 pillars has become very popular since we started this channel several years ago, and I have a very, very in-depth way of looking at the 8 pillars. So if you're interested in getting a more in-depth analysis of what the 8 pillars mean and why I selected them, click the link below, sign up for our free PDF. It'll be sent to you immediately, and it's a great way of allowing yourself to think about companies from a high-level perspective and what questions to ask from there. Now, remember, as I said before, I invest differently because I've got businesses and real estate upstairs. This is my recommendation for everybody. Dollar cost average to meet your financial goals. If you have a certain goal for retirement and you've used our retirement calculator and you say, okay, if I save $1,000 a month, I will hit my goal. That $1,000 a month, put it in the low-cost ETFs. Any extra money you have, if you choose to buy individual stocks, follow a process that works for you. You can't control the market. You can't predict when the next crash is going to hit. But what you can control is your mindset, your preparation, and your discipline. Crashes don't destroy wealth. Emotional decisions do. If you're out there chasing hype, timing trends, or letting CNBC dictate your strategy, you're playing the wrong game. Guys, CNBC is the worst place to go to for investment advice. But if you're focused on buying great companies at great prices, you've got to be okay thinking a little different, going against the grain, understanding their long-term cash flow and sticking to your process. Nothing is better than finding a company that's dropping in price, even though fundamentals are getting better. That's what's awesome, and it will happen. So when the next wave of fear hits, and trust me, it will, don't run, don't flinch. Just smile and say, perfect, I've prepared for this. Let's go find some deals. That's how true wealth is built in the long run, not by following the herd, thinking like an investor. Now, guys, there may be a bigger game being played by a lot of people out there. And if it's true, it could shake the market even more in 2025. This crash may not be random. If it's part of a bigger plan, then understanding why it's happening isn't just interesting, it's essential. I'm not talking about conspiracy theories, I don't believe in them. But click the video on the screen. Let's connect the dots and get ahead while everyone else is still reacting. Thank you for your time.